In this video, I'll go over all the fundamentals of closed-end funds and how you can earn a solid income by investing in them. And we're starting right now. Hey guys, Elliot here. So if you watch my channel, you know that I'm a big fan of high dividend income investing. And my portfolio has a diverse array of income generating equities, such as ultra high dividend stocks, covered call ETFs, business development corporations, and the subject of today's video, closed-end funds. Let's discuss what they are, their pros and cons, and what sort of income they can generate for you. As always, if you enjoyed this video, please do consider subscribing to the channel so you don't miss any of the upcoming investing and finance videos just like this one, and don't forget to smash the like button. To understand what closed-end funds or CEFs are, you can start with regular mutual funds or exchange-traded funds. Both are nothing more than a pool of investor money that is managed or unmanaged, but in both cases it's used to invest in equities or debt or whatever it may be for that particular mutual fund or ETF. If you want to learn more about mutual funds and ETFs, by the way, there's a couple of links in the description below to a few videos of mine that will get you up to speed. Now, closed-end funds start out as a fundamentally similar idea. They collect money from investors and away they go, investing in whatever the strategy dictates. However, how CEFs are structured and how they operate sets them apart from mutual funds and ETFs, and those differences are fairly significant. To understand the main difference, you have to look at the first two words in the CEF name, and that is closed-end. That means once the fund raises money, typically through an initial public offering, there's no further influx of cash. Thus, once the CEF receives its funds and buys all the securities that its management decides on, no more money comes in or out, and the number of outstanding shares generally stays the same. The fund then works with its holdings to generate income in a number of different ways, while often using leverage to boost the gains. So now that I define what a CEF is, it's good to take a step back and ask the question, why would you want to invest in CEFs in the first place? What advantage do they give you, the investor, and just as importantly, what are the downsides? Well, there are two distinct advantages that a CEF holds over a traditional mutual fund or ETF. The first advantage is more efficient portfolio management. Because the fund is closed, management doesn't have to worry about assets and cash flowing in or out of the fund, and can work with a stable pool of capital. They can then focus on long-term strategy, use leveraging, or go after specialized investments, and are never forced to sell securities in a declining market to meet redemptions. Conversely, in a bull market, fund managers are not inundated with new cash that they must invest at rising prices. This stable capital base contributes to closed-end funds' reputation for superior dividend earnings. The second and very significant advantage has to do with you, the investor, being able to purchase shares of many CEFs at discount. Unlike regular mutual funds or ETFs, whose value is directly linked to their holdings, which is known as net asset value or the NAV, closed-end shares can fluctuate up and down in value just like any stock, and often trade below their NAV, or in other words, below the aggregate value of their holdings. Thus, an investor who does careful research can pick up CEF shares at 5, 10, or even 20% discount. Like a temporarily down but otherwise quality stock, CEF shares can rise back up in value, and some CEFs even have a finite term of existence, where upon termination all the holdings are sold off at full NAV value, which just means an extra juicy payment for you, the investor, so it definitely pays to find CEFs at discount. Now, if you're listening to all this and wondering, why haven't I heard of closed-end funds before? Well, they are a bit more complex in nature than regular mutual funds or ETFs, and also tend to be less liquid and more volatile in some cases. And in general, they are more obscure in the world of retail investing, and they do get overlooked quite often. They have, however, been around a lot longer than open-ended mutual funds and ETFs, and were first available as far back as 1893, and were formally organized under the regulations of the Investment Company Act in 1940. So you could say CEFs are the original mutual funds, appearing some 30 years before their open-ended and much more familiar cousins. Now, I mentioned earlier that many CEFs are leveraged and borrow money in order to increase investment returns. In cases where they are leveraged, it actually turns out that they're not highly so. Regulations allow CEFs to issue debt and preferred shares with strict limits on the allowed leverage. For debt, there's a 33% limit, and for preferred shares, it's 50%. This is important to know because any leverage increases investment risk, but compared to certain hedge funds and other investing approaches such as call options, equity futures, or margin loans, CEFs are fairly tame and should be within the risk tolerance of most retail investors. So what do closed-end funds invest in? Well, there are four main categories or types of recognized CEFs with numerous subcategories within each type. The first and largest CEF type invests in tax-free debt income, and that of course refers to municipal bonds, or also known as munis. These are bonds that are issued by states, city, or local municipalities for general government need or to fund public projects. The second CEF type invests in taxable debt income, and that of course refers to government agency or corporate bonds, as well as federal government bills and notes. The third CEF type invests in U.S. equities. This is a fairly broad category that can include just about any type of stocks, such as dividend, growth, or value, as well as real estate investment trusts or REITs and master limited partnerships or MLPs. And it can even include a strategy involving covered calls. The fourth and final CEF type is non-US funds, and these CEFs invest in overseas emerging market stocks as well as foreign government debt. The goal of nearly all CEFs is income, and most of these funds pay out a generous dividend on a monthly and sometimes quarterly basis. And these can range from 7% all the way up to 11 or 12%. These payouts come from interest and dividends earned inside the fund, realized capital gains, and sometimes from what is called return of capital, which is generally the least desirable source, as that draws down the fund's primary holdings. That is something you need to look out for, and if a CEF that you're investing in relies too heavily on return of capital, it might be time to look for another investing opportunity. As with any management fund, there are expense ratios and management fees to consider, and that is something you can look up in the CEF's prospectus. There are also tax implications, as closed-end funds pass through their tax obligations to the investor. Since you don't control when you receive your distributions, you need to determine how exactly that will impact your taxes. Because CEF shares are only available on the secondary market, you need to buy them through a broker. When researching CEFs, look for a significant discount below the NAV, distributions funded by income, leveraging at 35% or less, and management fees in the 1% range or less. An excellent site that I use for my research is CEFconnect.com, which is a free database of closed-end funds with tools to compare them. So after all this talk about closed-end funds, let's ask, are they a good investment? In general, they are certainly worth a look. They can be part of a high dividend portfolio like they are in my case, and they can diversify your holdings if placed alongside covered call ETFs, business development corporations, real estate investment trusts, energy stocks, and other ultra-high dividend-paying investments. Because so many CEFs are leveraged, there is a risk of them underperforming in a down market, so there's certainly a bit of an elevated risk there. CEFs will require you to do some research to filter out the good ones to buy, and they are more appropriate for financially savvy, hands-on active investors. On the flip side, their dividends are hard to beat, ranging, as I said before, from 7 to 12%. Now, if you need a starting point for learning about specific closed-end funds, here's a half dozen that I either have in my portfolio or was actively researching at the time this video was made. Now, these are not endorsements or even recommendations, and you should absolutely do your own research before investing. Okay, so that was a general introduction to an overview of closed-end funds. If you enjoyed this video and found it useful, please do consider subscribing to the channel and turning on notifications so you don't miss any future videos just like this one. Thanks for watching, and I'll see you guys soon.